we have discussed the taxation. Now, because as you can see, the course is advanced taxation and management accounting. Let us quickly rush down to the management accounting, because today will be the last class I'll be having with you. So, management accounting. In every organizations, there are two major things in common for the purpose of effective management and business efficiency, and they are the goals and informations. Okay, what are the objectives that have been set down by the business owner? Then, and what are those informations that needed to carry out those objectives? And part of the informations, we have the external informations and we have the internal informations. So, according to Chartered Institute of Management Accounting, they define management accounting as the application of the professional knowledge and the skill in the preparation and presentation of accounting information, so as to assist the management in the formulation of the policies, planning, and controlling of the activities of the business enterprise. So when you look at that, what are those informations that are needed? We have as I have said earlier, we have internal information, then we have the external information. The internal information can be generated as a result of the financial, the volume of the finance or capital that has been ventured or invested into the business. So the management accounting now is the study of which has to do with the provision of the information and the interpretation of such information required by the management, so that they will be able to use that information to plan. Then they use that information to formulate the policy. Then at the same time, they use that information to control the activities of the organization, either presently or in future time. At the same time, they use the information in decision making. That is, they make a choice among the alternatives. At the same time, they use that information in order to evaluate the performance, whether they have done well or not, whether they have made profit or they have made loss. Now, management accounting and the manager. Who are the managers? And then what is the management accounting, as I've explained? The process of solving the managerial problems involve planning, controlling, and decision making. So these are known as functions of the management. Well, basically we call it post cost, as I've explained earlier to you. We have the post cost. That is, we have to set out a very good, brilliant planning, because planning means setting an organizational goals, deciding on how best to achieve them. Then it is also obvious that one of the most important tools of planning is budget, which is known as the financial implication of the planning. Are you getting it? So the planning helps to reduce the negative influence of uncertainty in the attainment of the objectives. So by helping the organization to cope with the challenges, then at the same time, it also serves as an expression of the purpose and focus. So it's as a guide to action. Then control as well. Control is basically involved ensuring that every aspect of the organization's work according to the plans. That is, every aspect of the organization's plans comes to true according to the work, according to how it was planned. So controlling is just the ability of the management to command and direct the activities of the organization in the most desired way. Now, look at the purpose of the control. Adaptation of the organization to environmental charges, limiting the accumulations of the errors, then to cope with organizational complexity, then to minimize the cost. So there are three major types of the control in an organization. We have the operational control, we have the financial control, and structural control. So that is that. Then the difference between the management accounting and financial accounting, yes, they are a bit different from one another because their objectives are not the same. The objectives of financial accounting is just to comply with the legal requirement, accountabilities, and stewardship. But for the management accounting, their main objective is just to make sure that they actualize the plan and controlling that plan to a particular extent. Then the rules and regulations. Yes, there are rules and regulations like structural adjustment. What do you call the statement of accounting structure, the international accounting uh, statement and structure, the Company and Allied Matters Act of 1990, among the rest. So then there is no rules and regulations that has to be followed in management accounting. Then the users, internal and external users. It is only internal users that make use of the management accounting in the most cases. Then time focus. Time focus for financial accounting is historical. Why that of the management accounting is futuristic. So the details, it is less detailed. Why the management accounting is more and voluminous detail. Then scope, the narrow than the management accounting. Why that of the management accounting is wider than the financial accounting. So periodicity, yes, less frequent. That is biannual or yearly or annually. More effectively, even the management accounting is basically every day among the others one. So when you look at that, that's about the differences. Then cost classifications. When we are talking of the cost classifications, it's just the process of grouping the cost according to their characteristics, depending on the purpose for which it is to be used. So cost may be classified according to the following criteria. Yes, according to the planning and decision-making classifications, functional classifications, then traceabilities to product classifications, then behavioral classifications, then natural classifications. Now, cost of behavior. The cost of behavior refers to the way and manner the cost react to charge in the activities level or the level of activities. So the needs of the cost behavioral pattern, we have the prepare. You need to prepare the budget. Then ascertain the cost of what of the product or services. Then you need to undertake the variance analysis. That is the difference between the profit and the loss. So that is on that. Then there is behavioral classifications. Cost items are classified based on their reactions to the activities level as a result of changes in the cost item. Because the cost item can be broadly classified into major 4 groups. We have the cost variables, we have the fixed cost. When we are talking about the cost variable, it is the cost that move in sympathy with the level of activities. That is variables. As the output is increasing, the cost of variables will also be increasing. But as the output is decreasing, the cost of variable will also be what? Will also be increasing or decreasing as the case may be. So that is why we have variable cost. Then we have the fixed cost. The fixed cost is the type of the cost that does not move or change within the relevant range output. So irrespective of the increase or decrease of the output, the fixed cost will remain what? Will remain the same. Then we have the step cost. This is the cost that can be increased slightly with the significant changes in the activity level. So it increases significantly whenever a specific level of activities is what is exceeded. You can see from the screen, you can see the graph there where we have the cost, we have the fixed cost, then we have the activities level. Then there is what we call mixed cost as well. Then this is the mixed cost is just the cost that combine both the fixed cost, the fixed component and the variable component. Like when we are talking of the electricity bill, which contains a fixed element. So the standing charge changes and the variable element per unit consumed. So look at the graph as it is. So I think you can see it from the examples. Limited gives the Zoro Nigeria Limited gives the following information. See the output, the total cost. Are you getting it? So we have the 800, 2,960, 1,002, 3,940, 1,005, 4,006. So you look at that. Then the now say we should calculate the following. You are required to calculate the variable cost per unit, total variable cost per unit, fixed cost per unit, and the total fixed cost per unit. So I think you can see it. Now, when you look at that, that is the output. That is the fixed cost per unit. By the function of the formula used. So because the total variable cost is equal to total cost minus total fixed cost. That is the total variable cost. Total variable cost could be arrived at by removing the total cost from the total fixed cost. Then variable cost per unit is going to be total variable cost all over the output. Can you get it? So we have the number 3 aspect of the question. We now have the fixed cost per unit. That is going to be the total fixed cost all over output per output. That is, then we have the total cost. Total cost per unit is going to be fixed cost per unit plus variable cost per unit. So when you look at that, you can discover that variable cost per unit remains constant. Then the total variable cost increase as the output increases. When you look at the table, you will discover what I'm talking about. It's quite unfortunate that there is no enough time for us to have explain that. So now, type of then we have what they call standard costing and variance. What does that mean? When we are talking of the standard costing, it is just a technique which establishes the predetermined estimate of the cost of the product or services. Then compare these predetermined costs with the actual costs as they are incurred. So these predetermined costs are known as standard costs. And the difference between the standard cost and the actual cost are known as variance. So the process by which the difference between the standard cost and the actual cost is broken down into its various elements is called variance analysis. Is that one clear? So the standard cost can also be defined as a predetermined calculation of how much cost should be under specified working conditions. So it is a target cost which should be what? Should be attained. What are the types of the standard? Then we have the basic standard, we have the ID standard, we have the attainable and or expected standard. Then we have the current standard. So what are the benefits of the standard costing? If you are talking of the standard costing, what are the main benefits that they make available to the business entity? Yes, a carefully planned standard is a guide to accurate budgeting. Through the standard budgeting or standard costing rather, we will be able to achieve, to be guided accurately towards the budgeted amount. Then the standard of efficiency increases since every one of the organizations knows its goals. I think you can get that. Then it also helps to interpret the management profits or report. Then it helps the management in formulating pricing and other strategic policy. Yes, it also avoids unnecessary expenditures in inventory evaluations, among the other ones. Yes, despite the fact that they are beneficial to the management and they are also beneficial to the business entity, they still have their own problem, of course. What are the problems of the standard cost or costing? Yes, the problem of incorporating inflations into the plan, unit cost. Then the problem of deciding the appropriate quality of the materials that will be used for production process. And at the same time, the problem of poor performance efficiency at the rate of pay with labor union. And the problem of deciding on the appropriate materials mixtures, where a product has more than one type of raw materials among the other ones. So that is that. Then let us quickly move on to the performance appraisal. The performance appraisal comes as a result of the standard costing because it is otherwise called an evaluation of the aspect of the working relationship that emphasizes for both the boss and subordinate specific accountabilities area. So the performance appraiser or evaluation, it just a general meaning as an art of measuring the assignment of value or the performance of an employee. Yes, there are three different major methods of evaluation performance under responsibility accounting system. We have the absolute profit. Yes, if we want to evaluate whether the people are work as expected, we can determine that. We can note that, determine that, and know that through the what? Through the absolute profit as planned. Then return on the capital employed and residual performance evaluation is based on the profit recorded in the financial statement, and a division is considered efficient if it is able to increase the net worth of the organization, as you can see it. So there might be difficulties, of course. That is difficult in the using it for comparing the division of different sides. Then difficulties of isolating the controllable overhead. Now, ROCE, that is return on capital employed. How do we determine that? This measures the percentage of the total equity that is generated through the profit, and it is computed by dividing the total returns or profit with the total investment. So the ROCE, that is ROCE, can be determined by dividing profit by with capital employed multiplied by 100%. So that is that on that. So then we have a total asset, we have the total productive assets, we have the net asset, among the others. So what are the advantages of this? Division with different size are comparable. Then it also gives considerations to the capital base of divisions. Then the data input is compatible with the information contained in the financial statement. Then it is also a useful analytical device for appraising the various aspects of the performance. Yes, it has the disadvantages. It may lead to dysfunctional behavior. The profit used for the purpose of appraisal is subject to the various accounting conventions. Then it also ignores non-monetary objectives. So that is that on that. Then we have so we have what's yes, we have measurement of company's performance. Measure the performance of a company. Yes, we can measure the performance of a company through the accounting and functional ratios analysis. Now, what is financial ratio or ratio analysis? They are the ratios that are useful in accounting, and ratios in accounting are mostly used in calculation of the profit, commissions, and even the preparation of asset valuations and liabilities. Importance main classes of ratio for financial analysis. We have the markup, we have the margin, we have the manager's commission, we have the net profit as a percentage of sales, we have gross profit as a percentage of sales, we have the expenses percentage, expenses to sale percentage, among the other ones. Then we have short-term solvency as well. That is when we are talking about the current ratio, the quick ratio or asset ratio. We have the debt turnover, we have the credit turnover, we have the debtors collection period and credit payment period. Then stock turnover. Then under these categories again, we have a long-term solvency and stability. That is when we now have the interest cover, the dividend the cover, dividend cover, then total debt to stakeholders fund, then long-term debt to stakeholders fund, then proprietary ratio, then gearing ratio. Then in this actual and potential growth, we use this one to determine the growth and the development and the improvement of a company. That is net book values for ordinary shares, any per shares. Then price earning ratios. Then we have any yield. We have the dividend per share. Then we have the dividend yield among the other ones. Now, statement analysis. When we are talking of statement analysis, we talk of the sources of information for the financial analysis of a company. So if we need the statement analysis or the financial statement analysis of a particular company, we have some areas of account that has to be checked. That is when we talk of the balance sheet of the company. Then we look at the trading profit and loss account of the company. Then what are the notes to those assets or to those balance sheets and or the trading profit and loss account? And at the same time, any information that enable analysts to assess the company performance can also be found in the director's report, the register of the charges, register of the stakeholders' interest, and memorandum and article of association. So in definition now, the financial statement analysis is a process of identifying the financial strength and weakness. How do I mean it? We use the financial statement analysis to determine whether the company has made a profit or they have lost, or they have made a gain, or they have lost. So that is the strength. They may not make the profit, of course, and they may not even lose, but the accounting stability or status will be known. So the financial strength and the weakness of the company by the properly establishing a relationship between the items is the financial statement, that is the balance sheet, profit and loss account. And the purpose of financial analysis is just to provide the data for the decision making. Are we moving ahead? Are we continuing in the business, or we are quitting? Should we borrow money to augment our capital base? So by examining each figure in accounting and comparing each figure, then the corresponding figures in the previous year, then the figures in the accounting of others, similar business, then the budgeted figure. Then we also use that by computing ratios and comparing them with one another. That is the corresponding ratios in the previous year's accounting. That is why we use the preceding year, 2019, 2020. When we are calculating the ratio, we use 2 years or more to determine whether the company is moving forward or not. So the ratio of budgeted financial statement, and at the same time, is referred to an absolute analysis. Now, efficiency and profitability, gross profit to sale. That is when we have the gross profit all over sales. Then net profit to sale percentage, net profit all over sales multiplied by 100 all over 1. So that is that. Now, when you look at this, when you look at the efficiency, when you look at the efficiency, so when you look at the efficiency, you discover that I've explained that we have the gross profit to sales, gross profit to sales. Though when we have the gross profit to sales, we have the gross profit all over sales multiplied by 100, and the net profit to sales percentage. That is when we have the net profit all over sales. Net profit all over sales multiplied by 100. Then another one is expenses percentage. Expenses percentage. That is the individual expenses multiplied by 100 all over expenses. So then we have expenses to sales percentage, individual expenses all over sales multiplied by 100 all over 1. Then we have the sales to asset, that is asset turnover. And that is sales all over total assets. Then we have the sales to capital employed. We have the sales all over capital employed multiplied by 100 over 1. Then return on capital employed, that is ROCE, that is the net profit before the tax. Net profit before NBT, that is net profit before the tax all over capital employed multiplied by 100 all over 1. Now, under the category B, that short-term solvency and liquidity. So we have the current ratio. So basically, when we are talking of the current ratio, it is going to be calculated by current asset all over current liabilities, and all this one can be deduced from the balance sheet. Then we have the quick and acid ratio. That is liquid sales all over current liability. Then we have the debt turnover. Under the debt turnover, that is the credit sales. That is the credit sales. The credit sales all over trade debtor. Then we have the credit turnover as well. That is credit purchase all over trade creditor. Then we have the debtors collection period. When we are talking of this debtors collection period, that is the trade debtors at the end of the account all over credit sales multiplied by 12, because the end of the account is run for 12 months. That is why we use 12 here. We don't use 100. Then we have the creditors payment period. That is the credit, the trade creditors at the year end all over creditors purchase multiplied by 365 days. Then we have the stock turnover. That is the part of the sales all over average stock, or the cost of sale all over closing stock where there is no opening stock. Then we have the categories of long-term solvency and stability. Interest turnover. Interest turnover. On the basis of interest turnover, we use the operating profit all over what? All over interest. Then the dividend cover, that is the profit after the tax has been deducted, multiplied by preference dividend of any, if there is any. If there is any, we can use profit after the tax. Everything with this one I'm talking about now, under the dividend cover, can be used. We can use the statement of the profit and loss account. All the materials in the trading profit and loss account are the ones that are going to be used, because it is from it that we'll be able to determine the profit before the tax. And if there is any dividend of any nature, then we multiply it by the profit after the tax all over the ordinary dividend payable. Then we have the total debt to the shareholder. We have the total debt to the shareholders fund. That is the total liabilities all over the shareholders fund. Then the long-term debt to shareholder fund. We have the long-term liabilities all over shareholders fund. Then we have the proprietary ratio. That is the total tangible asset all over shareholders fund. Then we have gearing ratio. That is the fixed interest loan plus referential capital ordinary plus preference share capital all over ordinary share capital. That is that of ordinary share capital can be otherwise called owner's equity. Then there is another one, we call it investment. That is the actual and potential growth. Under this, we have net book value per ordinary shares. the net book value per ordinary shares. That is the net book value of ordinary shares all over number of ordinary shares in the company. And at the same time, we have the earning per shares. That is the total earning belonging to the ordinary shares all over number of the ordinary shares. Then we have the price per earning ratio. Price or earning per ratio. So that is the market price per ordinary shares all over earning per shares. Then we have earning yield. We have the earning per shares, all over market price per ordinary shares multiplied by 100. Then dividend per shares. That is the total dividends. Total dividends to the ordinary shares all over number of shares. So that is on the management accounting. But when you look at this, account, look at this profit and loss account, as I've said earlier, that most of the items I was trying to explain to you now could be found under the profit and loss account. So you can see Abe Limited profit and loss account. See the sales 1,494. The cost of the sale. Can you get it? Then we have the opening stock, we have the purchase. We have the closing stock. So gross profit, operating expenses. When we are talking of the operating expenses, you may not see it in bulk, but you need to look at what are those expenses. Look at the selling and distribution, that is 128. Admin and management, that is 62. Then financial expenses, that is 18. So that means you are using 208 as the value of what? Of operating expenses. You can see net profit, that is 150 and 192 for the preceding year and the actual year. So the provision for tax, 74,000. So profit after the tax, this is the profit after they are paid the what? They are paid the tax. Can you see it? Because they remove this 74,000 naira from 150. So when you look at that, you discover that it will give us this. Then dividends is 48. Transfer revenue reserves 28. You can see. So the market value is 1 naira 25 kobo multiplied by 2 naira. So look at it. They say you are required to calculate the significant ratio for each of the company. So you can see it. Abbey, first company, second company. So that is why we have. Okay, let us from here. Now, gross profit. By the virtue of the account, the trading profit and loss account given. So we have your gross profit to sales. That is the gross profit all over sales multiplied by 100. So when you look at the gross profit, you see we have something like 358 all over 1,494 multiplied by 100. So we have 23.96. Can you get that? So when you use the other company too, if you check the thing, you discover that there are two companies. That is Abe and what? That is Abe and Barry. So you use the other one as well. Abe, you can see it. That is the sales. Then this one is for the Barry. Are you getting it? So when you are doing that, you discover that at the end of the day, you will arrive to different value So from there, you'll be able to determine whether the company has moved forward or they have made profit or they have shifted their ground from where they were before. Then net profit to sales. So that is when we have a net profit all over sales multiplied by 100. So when you look at the account, we have a net, we have 150 as net profit all over 1,484 multiplied by 100. So here we have 10%. Then finance expenses under the percentage. So we have the finance all over expenses multiplied by 10. That is 100 all over what? All over 208. You can see it. It's equal to 18 all over 1 multiplied by 100. That is wherever. So that is that. But before we round off for today, let me quickly give you an assignment. Let me quickly give you an assignment. Assignment number 1. Assignment number 1. Management accounting. Management accounting can be used as a techniques to determine financial efficiency and effectiveness of an entity. Discuss. Management accounting. Management accounting can be used to determine the efficiency of a business entity. Discuss. Management accounting can be used to determine financial efficiency and effectiveness of a business entity. Discuss. I said management accounting can be discussed, can be used rather to determine the financial efficiency and effectiveness of a business entity. Discuss. Assignment number 2. Assignment number 2. Differentiate between the merger and acquisition. Differentiate between the merger and acquisition as a major method of increasing the financial efficiency of a business entity. Differentiate merger and acquisition as a method or means by which a business entity raised their financial status. So it is submittable to Adika's management consult 01 at gmail.com. Adika's management consult 01 at gmail.com. Adika's management consult 01 at gmail.com. So this is very discouraging. That is just 19 out of 501 students registered. So it is quite discouraging. But that is notwithstanding, I want to appreciate those of you that are online, and I wish you best of luck in your exams. So if there is any question of any nature, my number is on. So you can chat me up, you can call for whatever explanation that might be needed. So thank you very much for your time, and God bless you.